Your petrol prices, your inflation, even your stock market can be affected by one tiny route on the world map. And if something goes wrong there, markets may react very quickly. But why? Because sometimes the stability of global energy markets depend on surprisingly small places. And one of the most important of those places is a narrow waterway called as the Strait of Hormuz. In the next few minutes, I will show you why this route is so important, how it controls a large part of the global oil supply, and why investors around the world start watching markets very carefully when tensions rise there. Once you understand this connection, you will see why geopolitics can suddenly move the financial markets. The Strait of Hormuz is a narrow waterway connecting major oil producing countries to the global market. Every day, millions of barrels of oil move through this route. Tankers carrying energy to Asia, Europe, and other regions must pass through it. Because so much oil moves through a single route, even the possibility of disruption can make the markets nervous. But why does this matter so much for the oil prices? Because energy markets react very quickly to the supply risk. When traders believe that oil supply might be disrupted, prices can rise very quickly. Markets start pricing in the possibility of shortages, even if the disruption has not even happened yet. And when oil prices rise sharply, the effect spreads through the global economy. Transport becomes expensive, production costs rises, and inflation pressure begins to build. But the story does not stop here, because higher oil prices can also change how investors behave. When geopolitical tensions rise, global investors often become cautious. They start watching the energy markets, inflation risk, and economic stability. Sometimes capital moves towards safer assets like government bonds or gold. Now, this can increase the volatility in the financial markets. But it is important to understand something. Not every geopolitical shock leads to a long term crisis. So, the key question investors should ask is this: is the disruption temporary, or does it threaten the long term supply stability? Energy markets often react very quickly to the headlines, but markets also adjust quickly when supply conditions stabilize. That is why experienced investors focus on understanding the mechanism rather than reacting emotionally. And this is deeper lesson investors should take from events like these. Financial markets are deeply connected to the global system, energy supply route, trade networks, geopolitical stability. Sometimes a small geographic point can influence the oil prices, inflation expectation, and investor sentiment across the world. Which is why macro investors pay attention not just to the stock charts, but to the forces shaping the global economy. Because when global supply chains become uncertain, markets start reacting long before the real impact appears. Understanding those early signals is what separates reactive investors from informed investors. So, the next time markets suddenly react to geopolitical news, remember that the story may begin far away from the stock exchange. And if you want to understand how global events quietly move the markets, subscribe to this channel, because here we decode how the world shapes your portfolio.